Hi guys, and welcome to another episode of Crypto Editor UK. My name is Michael, and as always we bring you the very latest in price, hype and speculation in the wonderful world of crypto assets. Now, what I wanted to do today was something a bit different. I wanted just to step it up a little bit notch. So from the beginner to the more intermediate session for you guys and record a masterclass. What we'll be looking at today is moving averages on price charts and how they can help us to predict the market. And like I say, if you find that interesting, so please make sure to like, share and subscribe this video. And without any further ado, let's jump straight in right after this. Let's start the presentation on moving averages and chart reading, masterclass by Crypto Editor UK. In our introduction, simply put, moving averages smooth the price to form a trend indicator by looking at past performance. They do not predict price direction, but rather provide a current direction. They form the building blocks for other technical indicators such as Bollinger Bands and MACDs. So, what are moving averages? The two most popular types are SMA and EMA. SMA means simple moving average. A simple moving average is formed by computing the average price of an asset over a specific number of periods. Most moving averages are based on closing prices. For example, a 5-day simple moving average is the 5-day sum of closing prices divided by 5. Number 2 is the EMA, which is the exponential moving average. The exponential moving averages reduce the lag by applying more weight to recent prices. The weighting applied to the most recent price depends on the number of periods in the moving average. The SMA is the building block to calculate the EMA. So, let's compare SMA versus EMA. Not one is necessarily better to use than the other. However, SMA are typically used to identify support and resistance levels of a price in the short, mid and long term. So turning to this chart here, as described, the exponential moving average is born out of the simple moving average. And the main difference that you'll see here is the exponential moving average here is much more edgy, I'll say. It rises at a much more rapid and the movement is a bit more rapid and it's a bit more edgier. Whereas you compare that to the simple moving average, where you can see that the movement is very smoother, much more smoother, and also it would appear to be a slower movement. So the lag on an SMA line as opposed to an exponential line is slower and smoother, whereas the exponential is faster. Lengths and time frames. Short moving averages, which are 5 to 20 days, are best suited for short-term trends and trading. This is maybe best if you are day trading crypto assets and are looking to make maximum gains by looking at short-term action. Medium-term trends would tend to analyze 20 to 60-day periods. Long-term investors will prefer moving averages with 100-day or more periods. The most popular moving averages are as follows: 200 daily moving average, 50 daily moving average, and 10 daily moving average. Trend identification. So we can use the direction of the moving average delivers important information about prices, whether that average is simple or exponential. A rising moving average shows that prices are generally increasing. A falling moving average indicates that prices on average are falling. A rising long-term moving average reflects a long-term uptrend. A falling long-term moving average reflects a long-term downtrend. Now, as we can see from the price is indicated in the black line here. Okay, so the price, this is an example I'm showing you here. So the price is indicated in the black line, and the moving average is this pink line here. So as you can see, what happens is when the price goes above the moving average, as you can see here, just before April here, the price went above the moving average, and then it stayed above the moving average, and then the trend for higher prices began for a period of April until here, where there was a decline just going into the new year there. So once the price declined, you can see the price declines below the moving average, and the trend would then signal a falling price, because you can see that the price then stays below that moving average. Now what happens is when the price falls below the moving average, generally it would need a significant price pump to see it go back above. So here there's a 40 to 50% price gain, so an increase. 40% is shot up again past the moving average and over the moving average, and then that then would indicate a reversal in the price and a bullish price, so therefore an increase in the price. So that's how moving averages work, in the sense that it does help you to check the trend, and generally based on the moving average and on the price, once the price breaks above, then that would signal generally a price increase, and once the price breaks below a moving average, it will therefore indicate a trend of falling prices there. Next slide. So let's look at double crossovers. Two moving averages can be used together to generate crossover signals. For example, a system using a 50-day simple moving average and a 200-day simple moving average will be a medium to long-term outlook. A bullish crossover happens when the shorter moving average crosses above the longer moving average, and this is called a golden cross. A bearish crossover occurs when the shorter moving average crosses below the longer moving average, and this is known as a death cross. So let's look at this chart here and decipher what this means. So first, let's identify a golden cross. Okay, so a golden cross would indicate a bullish indicator in the price. So we'll look for the shorter moving average. So here we've got two moving averages here, the 10 daily moving average and the EMA 50 daily moving average. So when the shorter moving average crosses above the longer moving average, this will indicate a golden cross. So here the shorter moving average is the green one, the longer one's the red one. So the green one here, when it crosses above that line, the red one would then indicate a golden cross. So at this point, the first golden cross is here, at this point here, point just below point 2. So what's happened is you can see there's a golden cross here, and with that being said, the price has then significantly increased, as you can see here, following that golden cross. And as opposed to where you have a bearish outlook, which is caused by a death cross, that would be the shorter moving average crossing below the longer moving average. Okay, so once that crosses below, at this point here, you can see that it crossed below at point 1, and then the price took a sharp downturn, as you can see here. So that was a bearish or death cross. So price crossovers. Moving averages can also be used to generate signals with simple price crossovers. A bullish signal is generated when prices move above the moving average. A bearish signal is generated when prices move below the moving average. So, taking a look at this chart here, it would indicate a bullish signal when prices move above the moving average, okay? So, as you can see here, the black line representing the price. Here at the moment it's in between the two moving averages and it's stuck in between the moving averages, and then what happens is it dips below the 50 EMA. Okay, so that's the 50 EMA here, and the price dips below that. The price then breaks above the 50 EMA and then continues to break above the 200 EMA, which is the longer outlook. And that being said, as soon as the price breaks above that, you can see that the price then continues to rise. It's not only broken above the shorter term moving average, it's also broken above the longer term moving average, which is the 200 EMA. And as you can see, once it's broken above both of those, the price continues to rise, and the shorter term moving average, it continues to rise and bounce above the 50 daily EMA. And it uses that line as a line of support, so therefore you can identify the trend and identify that the price will continue to rise. Support and resistance. Moving averages can also act as support in an uptrend and resistance in a downtrend. A short-term uptrend might find support near the 20-day simple moving average, which is also used in Bollinger Bands. A long-term uptrend might find support near the 200-day simple moving average, which is the most popular long-term moving average. In fact, the 200-day moving average may offer support or resistance simply because it is so widely used. It is almost like a self-fulfilling prophecy. So you can see here, when you have a short-term uptrend, you can see that the price will almost use that as described in the previous slide, will use the moving average as a support. So rarely will you see the price then fall below that moving average, and you will note that this will be the support moving forward. And this chart here with this line, this moving average, a 200 moving average, indicates that. And at this point, you will see that the price falls below at various points. It's support, but it falls below at this point, and then it breaks below that moving average, and then now it's a reversal, and that becomes resistance, and that would indicate therefore that the price is in a downtrend and a bearish pattern. So, just to conclude, it is always best to trade in the direction of the trends. So when using the moving averages, the trend is your friend. Moving averages ensure that a trader is in line with the current trend. Now, that's the end of that video. I hope you really found that useful, because it's important to not only have a beginner's perspective of crypto, but also it's important to understand that a lot of it will come from reading charts and prices. And what I'd like to do is just take you to, just lastly, the Bitcoin price as it stands, okay? So as you can see here, we have a moving average represented by this orange line here. The price is using that as a support. As you can see here, the price remains above the moving average, and at this point here in April, the price then drops below that moving average, and that would indicate a bearish outlook in the short term for the price. However, again, the price has then broken back above that moving average, and it seems to be using that as a level of support here. And as you can see here, it clearly indicates that in the short term, the price is using the moving average as a support until we can read any further into the future. So that's the video for today. It was a masterclass, so a bit different from what we usually do. However, very educational. And I would like to say that if you do want to download the PowerPoint, please make sure to comment below with you subscribed, and also I've dropped my email address in the description and also in the pinned comments. Drop me an email. I will then be able to send you the full PowerPoint presentation that I've just been through there, because I think that it will be very helpful for you to keep that and just to revise that whilst you're making your journey, because ultimately once you get into crypto and assets, chart reading is something that you should be making sure that you can do. It will save you a lot of money. It will save you a lot of I suppose decisions which may come from an emotional viewpoint. Technical analysis is part of crypto, and it's important to have a handle on that. So again, until next time, see you soon.